Hello friends, in this video we will discuss another important topic of banking, that is reverse repo rate. So what is reverse repo rate? We all deposit our surplus funds with the banks, for which banks pay us a rate of interest. Now if in case the Reserve Bank of India is in the shortage of funds, where they will go? So they will go to the commercial banks, and from where they will be taking the funds. Another case can be the commercial banks may have additional funds with them, and what they will do with those additional funds, the funds will be deposited to the country's apex bank, that is Reserve Bank of India, for which they will be earning a rate of interest. And second case can be Reserve Bank of India may require funds and they may approach the commercial banks. So there can be two cases, whether the commercial banks have additional funds or the Reserve Bank of India is in need of the funds. So in this case, commercial banks will be lending the money to the Reserve Bank. So the rate at which now RBI is going to borrow these funds from the commercial bank is called reverse repo rate. You must remember this thing: whenever the central bank is borrowing funds from the commercial banks and it is for a short period of time, that rate will be called reverse repo rate. So the funds should be taken by Reserve Bank of India for a short period of time. Now, what is the full form of reverse repo rate? As we have done, the full form of repo rate was repurchase agreement. So the full form of reverse repo rate is reverse repurchase agreement or reverse repurchasing option rate. So commercial banks, what they will do, they will purchase the securities from the Reserve Bank of India, for example treasury bills, golds, bonds, and they will offer money to the Reserve Bank, for which they will be earning a rate of interest. So when RBI needs funds or when banks have the surplus funds, this entire procedure is done and the rate is called reverse repo rate. Now there is a difference between repo rate and reverse repo rate. The first important point is the repo rate is always higher than the reverse repo rate. And the second is, whenever the reverse repo rate is being made higher, what happens? It attracts the banks to store more funds with RBI, and they will not keep the funds with themselves, or they will not be giving the funds to the customers in the open market, but they will deposit the funds to the Reserve Bank of India. That is why, because the Reserve Bank is offering a good reverse repo rate. Now the current repo rate is decided by the RBI with its committee on the basis of economic situations, whether there is inflation or deflation. According to that, the reverse repo rates are revised. It is one of the monetary policy tools of RBI, and current reverse repo rate is 3.35. We have done in the previous video. The current repo rate was 6.50 and the current reverse repo rate is 3.35. It means whenever RBI will be taking the funds, it will be giving 3.35% interest to the commercial banks. Now who decides this reverse repo rate? This is same as we have done in case of repo rates. This is RBI governor who presides over bi-monthly meetings with its committee, MPC, Monetary Policy Committee. So they have the right to formulate, administer, modify this reverse repo rates, and this committee consists of 6 members. Now RBI changes this reverse repo rates according to the liquidity requirements of the country. Now in front of you there is a comparison between the repo rates and reverse repo rates. The major points are, whenever we talk about the repo rates, the lender is RBI and the borrower are the commercial banks. And whenever we talk about the reverse repo rates, the lender is the commercial banks and the borrower is the Reserve Bank of India. Now the objective of repo rate is to manage the short-term deficiency of the funds, and the objective of reverse repo rate is to control the overall supply of money in the economy. Rate of interest of reverse repo rate is higher than the reverse repo rate, and rate of interest of reverse repo rate is lower than the repo rate. So the full form of repo rate is repurchase agreement. The full form of reverse repo rate is reverse repurchase agreement. So how does this work? The commercial bank, they get funds from RBI, using the government bonds and collateral securities. This is repo rate. And commercial bank deposit their extra funds with RBI and they receive the money for that in the form of interest. The cost of the funds increases from commercial banks, hence the loans are becoming more expensive in case the repo rate is increased. So money supply in the economy decreases as the commercial bank par their more extra funds with the Reserve Bank. The cost of funds is lower for commercial banks lending to reduced interest rate on loans, and in case of reverse repo rate, money supply in the economy increases because the banks are lending more money and they are depositing the money with the Reserve Bank. So now we conclude the topic of reverse repo rate, that reverse repo rate loans are generally short-term borrowings, and the benefit to Reserve Bank is that it will be getting the overnight funds. Now the central bank, that is Reserve Bank, it increases or decreases the rates of reverse repo rate depending upon the macroeconomic factors. So whenever the Reserve Bank is increasing reverse repo rate, it provides incentive to the bank. So what they will do, they will park their additional funds with the central bank for a very short period of time. So thereby what will happen in the economy? The liquidity will be reduced in the banking system and the overall economy. So RBI will be getting the surplus money from the banks against the collateral of government securities on an overnight basis. So this was all about the reverse repo rate. Thanks a lot.